Hi, welcome to Money9. I'm Kartik Malhotra. Well, mid-cap and small-cap companies are declaring robust Q4 numbers, and experts believe this momentum is only going to continue. In fact, some of these stocks are quoting lifetime highs, and so are the indices, making new highs almost every day, the small-cap and the mid-cap indices. Is this the right time for you to park a little bit of your corpus into the small-cap and mid-cap funds, or is the party over? You're too late already. Vishal Dhawan, founder and CEO, Plan Ahead Wealth Advisors, is with us here on Money9. Hi, Vishal. Thank you so much. Welcome to the show. How are you doing?
Very well, thank you. It's a pleasure being here once again.
Thanks, Vishal. So, Vishal, we've seen the half the schemes in the mid cap and small cap category. In fact, 25 out of the 51 schemes available right now have given more than 100% returns in 1 year. Well, of course, the pandemic year may not be the best benchmark because the base was fairly low. But do you think this is the right time for investors to hop onto the small and mid cap journey?
I think it's very important to try to define the time frame from a slightly longer perspective, because what we need to remember is the strong outperformance of mid caps and small caps over the last 12 months has come after a very weak couple of years for mid caps and small caps. So when you look at data in terms of performances, you might want to stretch this period to a much longer time frame. And what you'll actually interestingly find the moment you do that is that the large caps actually outperformed in 2018 and 19 on the back of a very strong, recategorization of mutual funds that happened basis some new regulations from SEBI. And
Right.
then you saw 2020 come back for mid caps and small caps. So it's important to stretch this to a slightly longer period. To answer your question more specifically about whether it is the right time to come in, we think what tends to happen is there is the risk that investors face today, especially investors who are shorter term in nature, that they might come into something which has already gone up very significantly. And therefore, we would ask them to tread with caution when they're trying to buy small caps and mid caps today. However, for longer term investors who are clear that this is a part of their longer term allocation, they want to participate in the growth of India over a longer period of time, we think this is a good place to be in. And come in a staggered manner so that you can take care of the volatility which is normally associated with mid caps and small caps.
Right. So you said a longer term. How long is a long term in this particular scenario? Well, of course, we understand that the dividends of being invested in the long term are obviously better because of the power of compounding. But specifically in the case of small and mid cap, how long should the long term horizon be?
So our view is that equity cycles tend to be, especially in the small and mid cap, 7 to 10 year cycles, and therefore when
Okay.
investors are thinking longer term, longer term does not equal to 12 months or 24 months. Long term actually means 7 to 10 years, because we need to remember that a lot of your wealth in mid caps and small caps get created when these businesses keep getting larger and larger. And that normally requires time. It's very unlikely that businesses will become large very, very quickly or become from small cap to mid cap very fast. So I think if you're patient, give those businesses enough time to grow, take advantage of some of the opportunities that might lie in their specific sectors. I think the outcomes are likely to be much nicer.
Right. But what's the best strategy to go about selecting a right fund, Vishal? There are dozens of them available, and especially in the small cap, mid cap category, for an investor to go ahead and pick one fund or pick two funds, what are some of the indicators that should be kept in mind?
So we need to remember that the mid cap and small cap space, in contrast to the large cap space, tends to be relatively under researched, and there isn't so much of third party research that is necessarily available on a lot of mid cap and small cap names. So I think one of the things that's very important to understand is what's the process and what's the investment philosophy of a particular mutual fund manager who's managing the mid cap and small cap process. So I think the more you're able to read about that process, read interviews that the fund manager is giving, listen to him in terms of how he decides to pick stocks, etc. I think that might be very valuable. Also look for things like past track records, But look at
Right.
consistency in track records. I think there can be short periods of time where a fund can do very well and then it can fall off the radar. So look for consistency, because mid cap and small cap consistency is much harder to find than in other spaces because of the lack of research. And the third thing is, for a lot of investors, we think a more diversified portfolio and therefore a less concentrated portfolio on mid caps and small caps might actually be very useful. Because what you find is that, because a lot of them may not have the highest corporate governance standards, you do want to have the ability to actually go out and have lesser exposure to each stock, just in case something went wrong in some of the stocks that you actually bought.
Right. So that brings me to the question of asset allocation. Since you said the exposure in small cap and mid cap should be significantly lower than that of quality stocks. So what should that ratio roughly be? What should be the asset allocation for somebody who wants to diversify from large cap or blue chip indices and explore the small cap bucket or the mid cap bucket?
So we think ideally having about 15% in mid caps and about 10% in small caps. So effectively, the combination of both of these together at about 25%, with the balance 75% or so in large caps, is a good number to start off with. I think what's very important too, though, is that when investors do asset allocation, there is a tendency to do it at a top level, which means that they look at their equity and debt and do asset allocation at that level. I think within the equity component
Equity
also,
bucket.
if they
Yeah.
find that suddenly mid caps and small caps have become, say, 40% of their wealth because they've done much better, then they
Yeah.
should be rebalancing back to this 25% or so that I just discussed. Because that's the way to ensure that you are constantly on top of what is happening on the mid cap and small cap side as well.
Right. And when you attack the mid cap and small cap category, what is the strategy that you advise investors? Should it be actively managed funds or should index funds be considered? So what are some of the funds that are on your radar right now?
So what does tend to happen is, on the mid cap and small cap side, it's one of those spaces where, interestingly, there is still some evidence that over long periods of time, active can actually outperform passive, though that has not necessarily happened in the recent past. But otherwise, there has been long periods of time where this has actually been possible. And therefore, our view is that while you focus on passive when you're building your large cap portfolio, you focus on passive while building your international portfolio. When you're building your mid caps and small caps, you might deliberately choose to stay um, with the active funds. And also, I think it's important to diversify within the active funds as well, because what tends to happen is a lot of investors, keep focusing on having very few funds in their portfolio, and I think that's a great strategy when you're in very researched areas like large caps, for example. But when you're going to mid caps and small caps, it may not be a bad idea to have maybe two managers rather than just have one manager, unlike what you would do in a large cap fund.
Right. So in the passive fund space, which are the indices that one should track regularly and benchmark the performance of your portfolio against?
So in the large cap space, the Nifty 50 tends to be, the most tracked portfolio globally, and therefore that tends to be the ideal way to do it. Though a lot of investors prefer to do it through a index which is more broad based, like a 100 based index. But simply the amount of opportunities that you get to invest in the Nifty 50, because there is a much wider range of products available, make that as the most suitable benchmark for investors to use when they're trying to measure their large cap portfolio performance.
Right.
As
And
far
what
as
about the small caps and the mid caps?
So I think as far as the mid caps and small caps are concerned, our view is that tracking against an index does tend to be a little harder, because what ends up happening is, you could find that the excesses on the index can show up very, very quickly. For example, there has been points in time where there have been companies which have been loss making, which have been in the mid cap and small cap space, and they have distorted the valuation parameters on the mid cap and small cap index side. So our view is that ideally, you have very few options available on the passive side anyway for mid cap and small cap investing. So you might as well go to the active managers and try to pick funds there. So most of them would either benchmark against the BSE mid cap or the BSE small cap, or they would be using the NSE indices as an option. So I think each manager, because he can pick within that a particular index that they want to track. Our view is that there's no perfect answer on which is the right index to use there, but just be careful to look for consistency. I think that's the key in terms of performance there.
Right. And is consistency actually an inherent feature of small caps and mid caps, or do they tend to be more volatile? And what should be the indicators for an investor to decide when he or she should exit a particular actively managed fund, especially in the small cap and mid cap spaces?
So we think volatility is inherent in this segment because there tends to be a lot more ups and downs. But as far as consistency is concerned, it is possible to find consistent performers. Of course, they will also fall when markets fall, especially mid cap and small cap corrections can be pretty sharp. But I think the way to approach this is to say, yes, within the universe of mid cap and small cap funds, can I find those that are consistent in performance in terms of controlling downsides when markets fall well, or relatively better than other players, and when markets go up, also participate reasonably well as far as the upsides are concerned. There are a few indicators in terms of what to look for when something is coming to an end, and this is true for many segments, but especially true for mid and small cap. One is if you start to see cost of capital starting to move up, and conditions become tighter for access to finance. I think that becomes an important time to be careful because many of these companies may be leveraged, and therefore their cost of running the business goes up as money becomes more expensive. The second thing is look for relative valuation data. You could find that if you look at long-term valuation information, there will be times where mid caps and small caps quote at very high premiums as compared to what they would normally quote at, and that's a red flag normally. And the third thing to look for is very excessive retail participation happening, because it's normally a very strong contrarian signal in terms of having too much interest in small and mid cap. I have one kind of piece of advice that I want to give here, and that's to just address this misnomer that exists, or this misconception that exists, that small and mid cap is good or bad, and large cap is good or bad. I think what happens is you will find that certain industries are filled with players who are more large cap, and therefore the mid and small size players in those industries tend to find it much harder because the larger players are very well entrenched in that segment. For example, in the banking and financial services space. Whereas if you look at mid and small caps, you'll find that many of the companies which are mid and small cap might actually be leaders in the space that they operate in, even though from a market cap perspective, they are mid-sized. So I think we should avoid the assumption that mid and small cap is always going to be, not good companies, or, going to be very small and therefore going to get impacted the moment anything happens, because that may not reflect the reality. Just to give you an example, many of the largest hospitality players in the country are still mid-sized. And, as consumers, we are very happy to consume their services, in the normal course. And, the way we look at it is, why would you not participate in some of that if they were industry leaders in that space?
Right. So it's quality stocks that you need to go after. It doesn't matter whether they are small, medium, or large. Well, there's one audience question coming in, but before we go to that, and I pose that question to you, Vishal, since you're live right now, we've got some viewers sending in their queries. You also mentioned international funds. Now, within the international space, now again, if we were to look at the asset allocation within the equity bucket itself, you said about 25% towards small and mid cap and 75% towards blue chip. Now, this 75% should also be inclusive of some international exposure.
Yes, so I think what's interesting to see is that ideally for most investors, because they're just starting off with international investing, it's
Yeah.
most recommended that they start off with a broad-based index product when they're starting off. And if you look at, say, the S&P 500 as an example, which is representative of the, virtually the entire US market,
Right.
you'll find that that has about 85 odd percent of its exposure to large caps and about 15% of its exposure to mid and small cap put together. So effectively, what will end up happening is when you end up adding in a passive international strategy as well, it's very likely that it will end up being a large cap tilted exposure there also because of just the composition of the index.
Right. So, one audience question coming in, which I'll just flash it on the screen, Vishal, and see if you'd like to take that on. I think the question is specific to certain funds that the investor is investing in. So, Abhishek Gupta is writing in and he's asking, I started investing in L&T Emerging Business Fund in 2017. Please suggest, should I continue investing in this? And how's the fund? In fact, Abhishek also posed one more question in which he said, I'm also investing in Access Midcap and DSP Midcap Fund. So largely you're looking at L&T Emerging Business Fund, you're looking at Access Midcap and DSP Midcap. Is this a good asset allocation strategy for Abhishek Gupta?
So I would say that the Axis Midcap and the DSP Midcap have been far more consistent. So applying the parameters that we just discussed earlier on in the show, both Axis Midcap and DSP Midcap would probably meet the criteria. If you look at L&T Emerging Business, it's been relatively less consistent, and therefore, one might want to evaluate whether one wants to either stop putting fresh money in, which means that if you're going in through an SIP, which is the ideal way to buy into very volatile strategies, you might want to replace money going in the future with another, small cap fund. You could look at either Nippon Small Cap or DSP Small Cap as an option. And what you could do is with L&T Emerging Business that is already in your portfolio, you could continue to let what has already been invested stay there, but ensure no fresh money goes in. I think over a period of time, look at the performance carefully of L&T Emerging Business as well. If you find that it continues to be relatively inconsistent, then you'll want to exit from there, also keeping your exit load and tax in mind.
Right, Abhishek Gupta. I hope that answers your question. Well, unfortunately, lots more coming in, but that's all we have time for today on this show. Vishal Dhawan, thank you so much for being here with us on Money9. Just to sum it up, you said if you are investing in small caps and mid caps, which you must, it should be about 25% of your total equity exposure and stay invested for at least 7 to 10 years. Well, that's a wrap on this Money Masterclass with Vishal Dhawan. This is Kartik Malhotra signing off. Goodbye and have a nice day.